we are more likely than not moving into a world where, foreign stocks, particularly from a foreign equity investor's perspective, are going to look a lot better, meaning their own domestic markets are going to look a lot better from their own currency perspective than U.S. assets for an extended period of time. And so that's an underlying trend that I think is an important one tactically and strategically to be thinking about.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kaastrup-Larsen.
Bob, welcome back to the show. It's been about a year since Jem and I spoke with you, and I think it's fair to say that a few things has happened since then. So we're excited to have you back. How have you been?
Thanks so much for having me. It's been a lively year. I feel like we've been through kind of every regime you could imagine, right? Highly stimulative, and then the Doge and extended regime, and then run it hot. And tariffs. I mean, man, we just every day it's something new. Maybe
Absolutely.
Global war is coming.
You never know. You never know. Before I dive in, hi to you, Jem. How are you doing?
Doing well. Summer in Chicago. So this is always a good time to be alive.
Super. Now, Bob, when we had you on last year, you articulated what I think was an important macro framework of the post-COVID era, that we were in an income-driven expansion, not a credit boom. And that simple idea reframed everything. Why higher rates weren't breaking the system, why spending stayed resilient, why the Fed, frankly, looked a little bit lost. But here's the thing, we're 1 year on, and while consumers are still spending, they're leaning harder on credit. Profits, you could argue, are wobbling, inflation refuses to behave, and we're starting to see a quiet, or perhaps not so quiet, emergence of real fragility. And this is even before we take into account the international relations. So maybe to start off, I wanted to revisit the idea of the income loop and just ask the simple question, is it still running, or has that loop already cracked?
Yeah, I think the income-driven expansion in many ways sits underneath kind of everything that's going on, and a lot of what we sort of look at on the day-to-day basis is sort of the pressures and the wiggles on that income-driven expansion. But look, at a big picture level, even relative to where we were last year, labor markets, like the unemployment rate's basically flat. Income growth continues to run at about 5 to 6% nominal. Spending growth is running at about 5 to 6% nominal. And while there's sort of corners of the labor market that have clearly softened, particularly for younger workers or those who previously had lost their jobs, having a little bit harder time finding a job, the big picture story is the economy, absent any of these policy moves, we would continue to be in sort of a traditional late cycle environment where, unlike previous cycles, credit is still not a big part of the story, and where income growth is a big part of the story. I think the challenge here as we've entered with this new administration is there are essentially exogenous efforts that are making slower growth policy more of the norm ahead. And so that is, that's the challenge, is you sort of have a fine economy, particularly if you look backward looking, particularly sort of let's say the fundamentals, the underlying fundamentals are pretty good. And at the same time, you've got this policy almost by choice that could be creating disruption.
Yeah, actually, I'm going to jump in here, Niels. I think the other complicating factor is, when you do a 90-day pause on some really big thing like tariffs, it actually has the opposite effect of pulling forward demand, right? So not only can you not see the effects, you kind of might be seeing the opposite effects, and you would expect that, right? So I think it's very muddy right now. I think it's really, really hard to tease through the current data and see through it in any particular way. Is there anything that you're looking at, Bob, on the data front that's telling you like kind of 3 months forward how things might be looking as opposed to kind of where it is now?
Yeah, it's a good point, and we sort of had a pre-tariff set of demand, like in things like autos, that sort of pulled forward demand, and then now we're having sort of a run of activity ahead of the possibility that the pause rolls off. From a timely perspective, I'm the labor market, given the income growth dynamic, right? The labor market continues to be one of the core cornerstones of overall economic conditions. And of course, we see, weekly data with continuing and initial claims, which particularly initial claims are short-term leading, but then become, in most cycles, you want to think about interest rates and credit, and that's kind of the flow through, and that leads employment. But in this more income-driven expansion, those employment measures are actually very critical because they serve as the foundation of what's likely to transpire in the course of the next 3 to 6 months. And so we haven't really seen much disruption. I'd say what we've seen is a very, very gradual deterioration that would be commensurate with a gradual slowing of the economy that would be consistent with, a late cycle type environment. But nothing there is pointing to a problem. I think the challenge is that when you look on a backward looking basis, things are mostly fine because of the dynamics that I described. But then you have essentially the tariff shock, which is, let's say at current rates, between 15 and 20% on effective 2024 imports. That's like a 2% of GDP tax hike. Now, if we were talking about a 2% of a immediate 2% of GDP tax hike, everyone would be looking around and saying, yeah, growth is going to slow, demand's going to slow, growth's going to slow, profits are going to slow. Like, that would be kind of obvious to people. But instead, I think some combination of the, taco belief and a little bit of misunderstanding about how these things work means that everyone's sort of looking backwards and saying everything's going okay, if anything, a little bit better, and just kind of like missing the fact that there's a wall ahead of us that will eventually affect the economy if these tariffs stay in place.
Yeah, you can't help but feel like there's this uneasiness, right? That you're kind of in this eye of some storm. I think I'd add to that with, you have this new budget that in theory will get passed, right? That has also yet to hit markets. And my bigger issue, I know everybody's kind of focusing on employment, and I agree, you and I have agreed for quite some time secularly, this demand side economy relative to the supply side economy we've been running for the last 40 years, right? This income driven economy really has changes the whole picture, but it primarily does it through, in my opinion, through the inflation picture, right? The long-term interest rate picture. And so I'm curious to hear your thoughts on where you see kind of the other side of the storm, right? As we get through here on inflation. Obviously, backwards looking inflation looks like it's cooling. Everything seems hunky-dory, right? Growth is strong. Inflation seems to be cooling. I don't know. Love to hear your thoughts on that. If you're, again, any data that you're looking at. And particularly given kind of the supply-demand imbalance on the back end of the curve, right? What you're seeing back there vis-a-vis not just inflation, but also, what you think is likely to happen on the long
term.
Yeah,
I think the challenge right now in terms of inflation is in many ways the same, which is like, if nothing was going on, we'd basically be seeing a gradual cooling of inflation that, is still a little too high for the Fed's mandate, but like kind of okay, like stomachable by the Fed, such that they can at least, continue to cut rates very gradually in response. And now we get essentially a tariff shock. And, we've seen dynamics like this happen lots of times in the past, which is with VAT shocks, with VAT hikes, and what the second and third order effects of that are. And, consumers see those things. They see, even though it's a tax, right? And if it was a sales tax, you would think about it like a little bit differently. They see it in the price of the goods. And so then what ends up happening, they'll see the tariffs in the price of the goods. And so then they see higher inflation in terms of the things that they're buying. The challenge is if it doesn't get paired with higher nominal incomes, there's only one solution, which is that you have to reduce real spending, right? Like there is no other solution to that problem. I guess you could borrow more, but households aren't really likely to extract a lot of value out of their houses and things like that. That's kind of like, the old days. That's like 20 years ago, you'd lever up your house in this sort of scenario. Like, it doesn't seem like households want to do that. So basically it will lead to lower real spending. And I think the question is kind of, how does that imbalance work? How much does it get taken out of profits? How much does it get taken, does it flow through to prices? How much do those prices then slow demand? That's kind of the question. And, we've really never, there's been lots of individual case studies, like the case study of the washing machines and how they flowed through to prices, washing machine tariffs. But we've never been like, what we should do? Like, have a instantaneous 20% tariff in the single largest economy in the world and like let her ride and see what happens. Like, there's a lot of unknowns in terms of how exactly this is going to flow through to inflation. I think the real risk, the more strategic risk, is that you get another bout of inflation. The Fed's a little handcuffed. Like, they're not really going to tighten in response to incremental inflation here. They might not ease, but they're not really going to like tighten in response. And so you've got a sort of a tricky moment where you could sort of re-embed some elevated inflation expectations that are pretty undesirable, and that could then go over and influence, long-term bond market expectations, or maybe the currency more than long-term bond expectations, currency and gold more than bonds.
I think everybody's focused on the recessionary effects of tariffs, like this idea that tariffs may be inflationary as a first order, but as a second order, are they deflationary? But in my opinion, I think there are very few people thinking about the potential wage growth that may come from it, right? That's kind of the whole point of the tariffs, right? The whole point of the tariffs is to bring jobs back, and we're cutting immigration, right? But I hear very few people talking about wage growth that, once again, by the way, this has happened for 5 years, that deflation might not be, and recession might not be the actual result. That the actual result might actually be a demand push economy, which is what we're doing. Right? That's what populism, protectionism does. So I think the one thing, again, that people aren't thinking about is this could be inflationary, not just from a secular kind of, hey, we're taxing goods and the prices of things go up. But even on a secondary perspective, if we are cutting labor, right, that causes a problem, or cutting goods, and we need to create more goods here, that's a problem as well. And in terms of potentially creating demand, more demand.
Can I ask both of you a question here? So we seem to be driven much more by narratives than by data, compared to at least when I started out my career. I kind of agree with what Jim says, that, we should think about, the labor force and what happens with immigration. But from a completely outsider here across the pond, when I think about the new administration in the US, and you think about what they said they were going to do going into government, and they started out doing some of that, Doge is kind of a good example. But it just seems to me that a lot of that policy, they're just going straight back to what all governments do, and that is borrow more money, lift the deficit, et cetera, et cetera. So I'm kind of thinking, and obviously I have no idea whether that's going to happen, but maybe we're all just still believing the narrative they gave us with immigration, but in reality, it's just not really going to happen. We're going to see flashes of it on the news, but in reality, the labor force isn't really going to shrink in the U.S.
Oh, I don't know about that. I mean, the labor force in the U.S., labor force growth has gone from increasing at something like 2 million annualized pace to 0. That's a pretty huge adjustment that we're seeing. The challenge with it is that it takes time. There's no incremental labor to, let's say, construction labor, right? It's like it's a little hard to find someone, a little harder to find someone, a little harder to find someone. But if you combine the fact that we went from 3 million inbound immigration, of which about 2/3 were in the workforce, give or take, of that incremental focus, there's also people who are, there's children and people who are not in the workforce, but about 2/3 flowed into the workforce. Combined with the fact of the rescinding of various work visas. So most recently, just in the past week, the Supreme Court upholding the rescission of 500,000 work visas for immigrants that are from certain Latin American countries. Like, you're talking about a pretty big sucking out of the labor market dynamic. The thing that has not really happened is they haven't really deported anyone. Like, I had a chart recently where they had a big splash. We deported 70,000 people in our first 100 days. And you're like, that's a pace of like basically the same as the previous administration. So, okay, like good headline, lots of, patting ourselves on the back. That actually didn't matter. But the combination of things in terms of restricting essentially the inbound flow with some of this work visa rescission is meaningful in terms of this labor market, and will keep it tighter for longer for sure, and support wages, as Jem's saying.
Yeah, Bob, I couldn't agree more. Look, we've pulled off 2.4 million in supply of labor, and we're in an incredibly inelastic, tight labor market. It's fascinating, actually. Like, people are all focused on the tariffs. Will they not? But meantime, the immigration thing, which was one of the biggest things of the election, right? And one of the things we most worried about is ticking along, right? And that's a big deal to that inflationary push that we've been talking about.
So just another thing before we move on, and I don't know where you want to go with your questions, Jem, but debt seems to be creeping back. I think people, from what I can tell, spending more on their credit cards, hitting sort of record highs. I think there's rising delinquencies as well. Are we going towards some kind of maybe a hybrid regime, a little bit of both and not one or the other?
Well, I think probably what you're seeing there to some extent is a reflection of the K-shaped dynamic, where there are, the bottom quartile of I'd say financially stressed folks. It isn't necessarily consolidated solely amongst lower income cohorts. It's just, if anything, actually the most financially stressed are in the middle income areas of the market. And so I think what we're seeing is stress emerging as essentially they are reaching their limits around what are the different levers that they can pull in order to continue to keep up their consumption. And, things like the student loan repayment or restart is an example of the sorts of compiling stresses on those folks. Now, if you go back and look through time, often that would take the form of starting to create significant credit stress in financial institutions and then create a credit cutback, and that slowing of credit from boom to slowing would create a slowing of the economy. The thing that's going on right now is we haven't had so much of the debt boom part of things. And so it means that as those credit stresses emerge, their sort of second order effects are less significant than you'd typically see in like a traditional cyclical environment. So both things can be true, which is we have like a mostly fine income driven expansion, and there is a cohort of people who are financially stressed, and every week that goes by they become incrementally more stressed, probably not enough to bring down the overall economy though.
Yeah, Bob, I think one thing you highlight there, which I think is so critical, has been the case really for the last 5 years and as a secular trend, but I think is accelerating, is the top 10% of the distribution here in the United States now constitutes 40% of retail demand. And we are now beginning to institute policies that are, and paired with AI, the number one cohort that's going to be hurt there by AI's growth is that cohort. And we're instituting policies now that are actually continuing through protectionism and populism to help the bottom and move that money from kind of that top 10%. maybe money's still flowing to the top 0.1, right? But I think that is an incredibly important dynamic, this kind of K-shape that you're talking about. Everybody is really thinking about this still two-dimensionally, like the last 40 years, that if the economy slows down, then the long end of the curve, the yields will come down and inflation will go to zero, et cetera. But I really think this dynamic of continuing to send money to the bottom, send jobs to the bottom, right, and hollow out that top 10% is going to be a very, very big change from what we've seen.
I think the challenge is, in terms of the hollowing out, who actually gets the hollowed out, and it's probably, from my perspective, as you look at the pressures, it's more the middle that's kind of getting hollowed out, and sort of distribution going to the top and the bottom, which is kind of interesting in the sense of it aligns with the coalition, let's say, of the current administration, which is a bit of top and bottom coalition building from an income perspective. And so I guess in that sense, it shouldn't be all that surprising, but it's going to create a real stress point it creates a stress point amongst a cohort, a traditionally sort of stable cohort in the sort of, longer term, American prosperity sort of perspective that could, probably is creating stress or challenges from a long-term growth perspective. But in favor of sort of favoring the top and the very top and the bottom amongst, U.S. income cohorts.
Yeah, to add a little bit of color to that, there is no middle anymore, and compared to where it used to be. And when you say middle, what I'm actually seeing is again, that top, call it 1% down to 10%, right? Like it is top middle for me, right? It is top realistically that's coming from. It's just not the tip top. It's not where the majority is. It's from this kind of upper middle class. And it seems like we're sending enough money to the bottom, right? And we've seen this kind of the growth there where demand and growth there is pushing into a new lower middle class, a bit more of that. So we're definitely changing the demographic picture dramatically, but it is very nuanced, and details are making a big difference on outcomes and inflation. And I think that's really what's driving the stagflationary.
Yeah, I mean, part of the question, strategically, is the U.S. dynamism question, and a big cohort of the U.S. dynamism through time, like if you look back over the post-war period, has been basically picking the best of the middle and pushing them and giving them opportunity to go to the top, right? Plus,
right,
frankly, bringing in skilled immigrants who come to our various educational institutions and, benefit and stick around for a variety of reasons. And so part of the question here from a long-term growth perspective standpoint is, are you actually, meaningfully reducing the potential GDP growth of the economy, the sort of structural foundations of what creates innovation and long-term productivity gains of the U.S. economy, both through, hollowing out the middle class, reducing the desire for, reducing immigration and, let's say, challenging our knowledge institutions. And as a function of that, that'll have essentially negative dividends, we'll have drags on U.S. economic conditions for a while in favor of, essentially income transfer to the bottom. And, in some ways AI, is a productivity enhancing activity, but it's less compounded productivity gains and more isolated productivity gains, which may be beneficial in a shorter term time frame, but if you look out over a longer term time frame, could create challenges in terms of overall productivity growth, which kind of align with your sort of, with Jem, your sort of strategic inflationary dynamic, strategic slower growth, higher inflationary dynamic.
Yeah, it's really these two. I mean, if you really like simplify, there are two major forces, right? I mean, there's a bunch of others, but one is this protectionism, like the really China-US, right? Putting if we're really going to continue to put a real lever between the two, or kind of divide the two, that will drive, by definition, growth on the bottom. We will repatriotize the bottom, right? The cheapest goods of all, the cheapest production, the lowest end. And it's not just China, but that's the biggest part. Well, at the same time, in theory, you would think, well, the growth of AI, it's so fast and dramatic, it can replace, but that it's replacing a completely different sector, a completely different section. So we are getting massive deflation in one part and massive inflation in another part, if you really think about it. Assuming, I think we know where AI is going, although there's tons of policy changes and things can slow it down, et cetera. But the one big question, I guess this is where I would lead into as for a question for you, Bob, is where are we going with China? Because that is the biggest question of all, right? And I think that uncertainty, right? This taco trade, the uncertainty tied to what is happening, where are we actually going to end up is really the part that's hardest to put your finger on.
Yeah, I mean the where we go with China is so emblematic of all the different pressures that we're talking about from a strategic perspective, and I think the challenge here is there's a lot of uncertainty. I think it sort of goes back a little bit to taking the new administration kind of at its word in terms of what its priorities are, and kind of a little bit of the joke is like, if you want to understand what the administration was going to do, I basically just take the campaign rhetoric that's largely what they've pursued. It doesn't mean it's exclusively what they've pursued, but amongst immigration, tariffs, cutting the deficit was never really a big story. It was if you actually listen to the campaign rhetoric, it was never kind of like the big thing that was focused on. And it was much more around, reshoring and restricting immigration. And so when you go and you look at the I should say, and also military toughness was a big campaign rhetoric story as well. And when you go and look at the relationship with China through that lens, essentially it hit, let's call it a strategic decoupling with China, hits on all those dimensions in terms of helping support the base, in terms of, onshoring, helping restrict immigration, although Chinese immigration hasn't really been a big story, but the U.S. is doing what it can. There's still hundreds of thousands of students from China every year that we've basically now decided to kick out in one form or another. So that's a strategic decoupling. And then from a military perspective, basically figuring out ways to ensure that our military is disconnected from anything to do with China, whether it's about rare earths and things like that, or manufacturing. And so that kind of decoupling, that is kind of where we're going. And from a strategic perspective, what that means is you're basically duplicating a lot, right? We went through 30 years basically where we created a global economy that was really focused on creating the most efficient implementation of all manufacturing production everywhere. Right. And so whoever could do it the best, most efficiently, most effectively, just in time, all of that. And now imagine you've basically smashed that whole system to one which is a parallelization of supply chains, production, isolation, et cetera. And that inevitably creates a more, it can create a higher nominal growth support. It certainly supports nominal growth, but a lot of that is likely more through raising prices relative to raising sort of real economic activity, which is kind of, it's not really supported by this sort of activity.
Yeah, I actually agree. I have a slightly, I agree that's where we're heading now. There were some real questions in January though, right? Because I think the bringing in of Elon Musk and kind of the more wealthy, more traditional Republican small government kind of part of the coalition this time around, like Trump 1.0 very much was populism, protectionism. He was a vehicle of this. And to be clear, since 1982, he's been talking about this topic. So this is core to who Trump is, right? Protectionism, bringing back jobs to the U.S., not sending everything abroad. But this Trump 2.0 seemed like it would be potentially very different. And if you think about what they came in with, it was Doge, it was a lot of supply side, the big tax cuts, lowering kind of spending writ large. There was, SNAP payments and Medicaid cuts. And, meanwhile, there was a general thought process, and Bassett was out there vocally talking about it in January. Like, we need to get the private industry going again, right? But and I didn't think it would happen as quickly, but there was a real question. Which way are we going to go here? Are we going to try and go back? Are we going to maybe have a deal with China? And by the way, Elon also was kind of pushing for a resolution of some of the tariff stuff. They were kind of like willing to deal with it. But what we saw was in the first 100 days, a dramatically bad poll number for Trump, right? Like the worst since 1940s. And that resulted in a complete kind of, and by the way, like pitchforks and fire, like Molotov cocktails at Tesla, dealerships, right? And you put the wealthiest man in the world out in front, and you try and do a supply side policy in a populist protectionist time period. And guess what? That was in complete contradiction to who Trump's base is. And they just cut the cord, pushed the lifeboat off to sea, and sent Elon kind of off on his own. And not surprisingly now, Elon is kind of pushing back publicly against a lot of the policy. I mean, they're trying to play nice, right? But clearly this is going in a much more Trump 1.0 direction, to your point. And I think that is important. I think that's actually critical because there was some hope and a lot of things kind of going on in January, February. And I think we're right back to where we were, if not worse. And again, my only big question is what is going to happen with China, right? If there's some big deal with China, that can change everything.
Can I throw in a comment/question on, so you bring up China. I don't know if any of you have come across the new book that just came out like a week or two ago called Apple in China. Have you heard about that?
I have not, no.
Okay, definitely worth for you to check out. So the author is a journalist, Reuters journalist. He spent a number of years also, I think, in Asia. And essentially, he writes this book where he basically completely sort of describe how Apple built their supply chain and why it ended up in China. Just to give you a couple of stats and then kind of maybe hear your response or your thoughts about it. So based on Apple's own data now, in order to do this, in order to basically make their products as great as they are, they had to send thousands of the best engineers from Apple to China. So according to Apple data, from what I can tell in the news, Apple trained 28 million Chinese people. Okay. There are 3 million people working in China for Apple, only 160,000 outside of China. And according to him, the author Patrick McGee, Apple simply cannot produce. Even if they wanted, they cannot produce outside China. Nobody has the skill to do that. And you could almost go as far as I think he's kind of alluding to, that you could say, well, actually, Tim Cook is kind of pretty important in why China is more advanced than many of the Western countries today in the technology space, because Apple trained them to be. So my question is just, I mean, again, we hear all this rhetoric about, oh yeah, we're gonna bring jobs back to the US and all of that stuff. The question is really, have anyone from the new administration, maybe thought about, can it really be done? I mean, it's one thing to say it, the narrative is great, but can it really be done? I'm not so sure.
Well, I think that the challenge is when you get down to the details, it is a real challenge. And I think it's easy to talk about $5 trillion of, investment coming into the U.S., from various folks. And, it's a lot harder to actually, build the factories and get the supply chains over. And I think the biggest challenge on that is that it's not like we've created, for a lot of these areas, it's not like we've created smaller scale, but nonetheless nascent capabilities. So like if you look at something like steel and aluminum, we do have some steel manufacturing in the United States. And, it doesn't mean that we can meet all of our demand or whatever, but it does mean that there are skilled people who have worked in steel plants and, theoretically we could build it, but it's going to take 25 years to build up the full manufacturing capacity. A lot of area or autos, there's plenty of auto capability in terms of, people sitting in Southeast Michigan who have been doing this for a long time, even though, Southeast Michigan and Ontario, I should say. And so that's certainly possible. But a lot of the other stuff is not, a lot of the other manufacturing has not been in the U.S. for 25 years. The electronics, the furniture, the toys, a lot of the stuff that, can seem trivial, but really is part of our sort of day-to-day consumption and part of the inputs to all of the other things that happen, right? Lots of made in America things. I like to joke about my kids' shampoo, where sure the shampoo is made in America, but the bottle is made in China, right? And it's not like you could take delivery of the shampoo without the bottle, like that's.
I think someone posted a picture of a MAGA hat, and it said inside "Made in China."
Right, exactly.
Yeah.
So that's one of the challenges is just given that we're coming off of this 30 years of like just in time creation, most efficient supply chains possible. There's a lot of elements, a lot of disruption that if we go down the path of, let's call it the strategic embargo. Which I found it interesting that even Besant started saying embargo with China. Like the impact of that is not just on the imports. The impact of that is much broader than that. And, we're not that far away from that. We're right on the cusp of strategic embargo at 30% tariffs. If we're much higher than that, it's going to be really challenging and create magnified effects. Now, I think the only saving grace of this from a macroeconomic perspective is, like we saw in April, if this starts to get meaningfully priced in, it may start to create a response. Is that taco? Well, taco when equities are at all-time highs is a very different story than taco in response to 25% declines in equities. And so you're probably going to need more pain to roll back the behaviors to limit the impact on the economy than, we at least certainly where we are in terms of asset pricing right now.
Yeah, I mean, I think you have to, the reality is if we choose to prioritize median outcomes, it's painful. I mean, this is not going to happen. You're not going to fix 40 years of what we've done in a year or two. I think the key is separating, we're actually doing something with a long-term view, believe it or not, for the first time in 40, 50 years. And that takes short-term pain at the end of the day. The question is, will they be able to deal with the short-term pain? Because politically, they have to get reelected every 2 to 4 years. And I think that's the big question, right? Will they, and that's what these lags of, these delays, extensions, that's why taco exists, right? If you think about it, it's this short-term having to deal with markets, having to deal with the politics, which are very immediate and short-lived while you're trying to make big structural changes. And I'm guessing that's like an on-again, off-again kind of trying to manage what otherwise is a very difficult situation.
The basic path here is you either have to accept a significant amount of pain, which, like, in general, Western democracies are not particularly good at doing that outside, sort of proactively. In wartime, maybe, but proactively, that is not a particularly well-traveled path. Or what you have to do is create enough stimulative effect that offsets the painful, the pain part of the equation, right? Through either running large deficits, transfer payments, cushioning the challenges, running easier monetary policy than would be appropriate given, inflationary conditions or economic conditions. Basically do a bunch of offsets. And, and this is in black and white. It's not like terrible pain or, dumping money into the streets to offset what's going on. But I think probably what we're seeing is a path that has a bit of elements of both of those things, which is that there is some element of pain that's going to occur as we engage in, to some extent, some strategic decoupling that exists relative to the rest of the world. And then at the same time, some amount of, easy money policies that will offset that. And that combination of things, is not, it's interesting. It's like not particularly good for stocks. It's not particularly good for bonds. But it is pretty good for gold and bad for the dollar.
And actually, it's really good for the economy broadly, right? Like demand and rebuilding the middle class. Like the economy, by the way, does not have to be weak. Like this idea that the stock market is somehow tied to the strength of the economy, I think that part is going to break people's minds, right? Like that they don't necessarily have to be. I think we could get really strong above trend economic growth like the 60s and 70s, but with really, really poor equity market returns.
The sort of link between those 2 points, which you're making there, is that there's no reason why profit margins necessarily have to be pushing to all-time highs, right? Like you can have a circumstance where, if we have some moderation of profit margins, said differently, like part of the tax, and I describe it as a tax on the economy, not a tax necessarily on individuals, but a tax on the economy. Part of the way that can flow through is you can just have reduced profit margins. And reduced profit margins are obviously not good for stocks and not good for companies, but that reduced profit margin can flow through and be beneficial to individuals and wages and their spending. And so that's a way in which this can play out, which is like, not great real returns for stocks, not great profit margins pushing higher, essentially transfer payments, whatever, transferring the capital to the lower income cohorts who have higher wage growth and the outcomes that you're saying. And so that's a combination that can exist. The challenge, I think, for most investors is that is a pretty, just in the same way it was in the late 60s and the early 70s, like that is an awful outcome for most financial market investors because basically no one's prepared for that at all.
This is a perfect segue to actually, I think, another big important conversation that you and I actually have a lot in common on, think a lot about. I know with your unlimited funds, you do think about this a lot, but most people think, I'm just going to reiterate this idea, that if we have strong economic growth, like if you ask their average person, what drives the outcome for equities? They're like, well, if the economy is strong, stocks will do well. But the reality is, in real terms, from 68 to 82, this last time we saw interest rates go bottom left to top right, we saw, in real terms, 2.5% GDP growth, in real terms, above inflation, with a lot of inflation. So nominally, it was very high. That is significantly higher than we've seen in the last 40 years. That is 0.75%, almost a percent higher than the 1.7% or so we've seen in real terms for the last 40 years. But in the last 40 years, we've seen about 10% real annual, growth in the equity market, right? And 68 to 82, we saw negative 4% in real terms. Actually, in real terms, over negative 4% per year. So dramatically different outcomes. And the reason, as you highlighted, is because labor was getting a larger share of the earnings. Profit margins, which sat at a record for the time in 1968, collapsed into 1982. That's one. Two, the divisor, the discount rate, forced multiples from 23 PE in 1968 to 4.5. Why? Because in 1982, with a 20% 10-year bond, you needed a 21, 22% earnings yield of the S&P to invest in the S&P. It's that simple. And so this idea that the divisor was a much more mathematically powerful effect on equity values than the 0.75 or 1% economic growth per year is, mathematically, it's clear, it's obvious, not to mention the profit margin compression. So I think we could, like we were talking about, if you see a strong economic growth scenario where it is a demand push economy, where you are pushing money to the bottom, and rebuilding kind of your own economy, at the end of the day, that is going to have to make demand, first of all, for stocks go down dramatically, and that discount rate is going to ultimately weigh, and it does with a lag, as we know with the CAPE, right? In Shiller's CAPE, interest rates work with a long and variable lag. Why does that lag exist? Because 1968, similar thing. Here's a similar thing. Everybody goes in and gets debt, right? In 2020, 2021. And that debt has, that cash lasts for 5 years, 7 years. That's the average time period. But eventually, people have to come back and get that liquidity from the market at a much higher rate. And that's when the rebalance happens between stocks and bonds. So I see this whole thing playing out. We've been talking about it for 5 years, right? But I really think the economy will continue to be much stronger than people expect. I think this because we are sending money to demand, to the velocity of the people who take all the money they get and spend it, and we're taking it away from the velocity of zero people, the people at the top 0.1 or 1% or 2%, right, who spend maybe 10% of the money. I think that is a huge, huge deal and a very different outcome. But the reason this is important, now to kind of get off my soapbox and go back to you, Bob, is if that is the case, and we've seen periods like this, not just the 60s and 70s, investing 60-40 is a disaster. The Sharpe ratio of 60-40 for the last 40 years has been about 1. But if you take that period out of it, you know what the Sharpe ratio is of 60-40 in the last 125 years? 0.3.
Yeah, which is what you'd expect strategically for, two assets with a 0.25 Sharpe ratio and a modest positive correlation. That's what the portfolio should look like.
Right. The problem is it's very disjointed, right? During periods like the last 30, 40 years, the negative correlation of the bond and stock part of your portfolio, which has been relatively consistent, completely doesn't just break down and go to zero. It goes negative, right? It goes positive. Sorry, they become positively correlated, right? And that's because they're both subject to that discount rate. And so we go through decades, and this happens again and again throughout history, where stocks and bonds don't work. Everybody assumes passive investing is this new technology, this new innovation, that's the way to invest. Well, no, it's not. The reason it became popular in the late 80s was because interest rates went from the top left to the bottom right, and they continued for 40 years. Passive investing is not a new idea. We've had indexing for almost 150 years. It's the same thing. Why didn't anybody index invest consistently passively, even though we knew that was a thing, right, until about 40 years ago? I mean, think about it, right? It's pretty obvious. It didn't work. And so what happens when it stops working? Yet now everybody just does that. That's a lot of pain. And that's where you and I come into this, right? That's why alternatives and non-correlated assets are so critical. We're calling alternatives like private equity and private credit, right? Which are just leverage versions with no mark to market of the assets, stocks and bonds themselves. What we need is truly non-correlated assets. And I'll get off soapbox, but I'd love for you to talk a little bit about what you're trying to do there, how you're trying to make that more accessible, and get into some of the ways you do this. Because the real challenge is that some of these strategies are A, not scalable, and B, right? That's the problem with 60-40. Like, that's scalable. These alternatives cannot be. So how do you make them scalable, and how do you make them more accessible to people?
Yeah. Well, I think it all started. I totally agree with you in terms of the need to build better portfolios, and in particular build better portfolios that can withstand a wider range of different macroeconomic outcomes than basically peak disinflationary growth that we've seen right over the course of the last 40 years. And so I think one of the interesting things is if you take a step back and you just look at what are the strategies, what are the return streams that are the most diversifying to a 60-40 portfolio, what you basically see is private equity, private credit, and venture capital, which have been all the focus of the alternatives world, are basically useless. It's like if you want venture capital type returns, like go lever up stocks, go, like, it's fine that you can get that return stream for 1 basis point. Or private equity, certainly you can get that effective return stream for a basis point. the things that are truly diversifying there's basically three things that are diversifying to a 60-40 portfolio, meaningfully diversifying. One is gold, which nobody owns and is, about as cheap and easy a diversifier as you can get. And so if you take nothing away from this, you should go out and allocate more money to gold, some money to gold. Two is diversified commodities, which, there's now lots of ways in which you can gain access to diversified commodities. I mean, like industrial, oil, copper, et cetera. Those are actually strategically beneficial and then tactically very interesting if you just think about how the world is pricing in nominal economic conditions right now. Basically, extractive commodities are weak at a time when stocks are very, very high. So even if you believe the economy will be great, why wouldn't you be buying extractive commodities since they're so cheap relative to essentially equities on a global basis? And then the third is alpha strategies, diversified alpha strategies, and particular macro diversified alpha strategies. And I think that's very important because the ability to bring to bear long and short being an important component, long and short positions and flexibility is really important. The key issue is you have to be able to do that at a much lower fee point, because if you pay people 2 and 20, you basically eat away, all the alpha's gone. The manager takes away all the alpha. And so, and having sat in the seat taking the alpha, it's a pretty good business if you can take all the alpha for yourself, right? In the fees. But if you can get access, and this is, really what we're focused on, is how do we create access to these alpha strategies without all the fees, right? Without all the negative tax implications and things like that. Because if you get access to those are essentially the most compelling diversifiers that you can have in your portfolio. So if you just took your 60-40 and you shifted and you put in gold, diversified commodities, and diversified alpha at a low cost, you can, particularly macro strategies, you can meaningfully improve the quality of the performance of your portfolio from a reliability standpoint relative to 60-40, even in pretty good 60-40 times, which is important to recognize.
Yeah. I mean, at Kai Wealth, where, instead of a 60-40, we really are focused on kind of 30% non-correlated. Like when we talk about alternatives, similar to you, it truly is alpha strategies, non-correlated strategies. The current portfolio for most endowments and foundations is not just 60-40, it's worse, because some of them have 60 to 70, like a lot of them have 60 to 70% exposure in privates, which is leveraged equity, leveraged credit with no liquidity, right? With 5-10 year lockups and 2 and 20 fees. They're basically paying for leverage, and they're kind of saying, well, that volatility number that defines a Sharpe ratio, doesn't exist because we don't see it. And that's been the case, by the way, for 40 years. That works great in an environment where you don't have a drawdown in equity performance that lasts longer than 4 years. Because if you have a 10-year lockup, then you never see that volatility. What happens when that drawdown is 10, 15, 20 years and your levered equities at 2 and 20? I think there's a lot of pain that could happen in private equity and private credit. I think it's something that, again, will happen. It'll be a slow motion train wreck and then eventually accelerate, because it'll be a function of a drawdown and a mark to market that will actually be experienced by investors because it'll last longer than a decade. And so I think that's the big story, is how do we all, what is an alternative, and how do we get access to that at scale? There's a lot of alpha strategies. There's global macro, as you mentioned, but I can name merger arbitrage, convertible arbitrage, managed futures, trend following, distress, debt event driven, commodity focused, long short equity, long short credit. I mean, we could go on. There's like 100, right? And I think most of these are foreign words to your average investor, and I don't think they will be in 3, 4, 5 years. I think also importantly, this is my hobby horse, but derivatives, options are a huge, huge game changer here, because not only do they allow you to take access to non-correlated bets, right? Not just up, down. They allow you to get capital efficiency. And as interest rates go higher, capital efficiency becomes paramount. This idea of stacking yield, right? Getting that T-bill rate, right? And then being able to, on top of that, stack a non-correlated yield. You don't need much alpha to start making, a really good-looking kind of non-correlated strategy. You can get it at scale too if you can stack. And I think that's an important concept that I think very few people know and understand now. But I think that's 1% of the market or 0.5% of the market, which has doubled and tripled in the last several years. That's going to double again. And I was just at an equity derivatives conference, like twice as many people there than last year. Right. And structured products, by the way, have gone from 500 billion issuance a year to 1.5 trillion in 3 years. I think that is a world that is just ripe for explosion, right? In terms of just, demand, and it's becoming more and more efficient. I think we're really hitting a tipping point there.
Yeah, I think that the challenge for a lot of folks when they're looking at this, though, is how do you pick your manager? That's the big pickle. Like if you talk to the advisor on the street, right, the guy in Dubuque who's trying to build his portfolios, and so from our perspective, a big part of what we've been trying to do is remove the single manager idiosyncrasy. Nothing against what you're doing, Jem.
I agree with that. But no, to be clear, I completely agree
with this
with
idea.
The diversification is the cheat
right,
code.
Exactly. And in particular, what you see when it comes to alpha strategies is if you just take, as you say, that universe of there's a bunch of different ways you can generate alpha. And if you can, if you look at all those different managers, they basically all generate alpha. And particularly if you bring the fees down, they definitely generate consistent alpha over time.
Absolutely.
As a group, as a cohort, and it makes sense. Like, look, you've got the smartest minds in finance, like all trying to figure out how to beat markets. Like, yes, they should generate alpha over time. The challenge is that any one manager, it's like, what's going to happen with that one manager? They might be down 30, they might be up 30. Like, it looks random when you pick one manager. But from our perspective, if you what you can do is you can index alpha. Now that alpha indexation totally changes the game because you get that manager diversification, which allows you to get a more consistent benefit, right? More consistent drawing on that wisdom of the crowd. And if you can do that at low cost and higher target return, like that is a combination that can be very, very compelling for a lot of portfolios. And frankly, hasn't really existed until, you could put it into an ETF wrapper.
Yeah, this is a critical point. Like, if anybody's listening, like, this is so critical. People think that these big Millennium, Citadel, Point72, Balyasny returns for the last 25 years are because these guys are geniuses. It's actually way simpler. And the fear about hedge funds is, overstated. What is happening at a multi-strategy hedge fund is this idea of diversification. That is at the core of the success of this true diversification. Not like diversifying stocks, but not diversifying your roots. Truly non-correlated distribution of returns if you take 50 different strategies that are truly non-correlated from each other and don't own an asset, so they're not exposed to the same thing. At the end of the day, you can have a bunch of 10% yielding strategies or 9% yielding strategies that may not be that exciting, right? That have maybe a one sharp, which sound pretty good, but like aren't hitting a home run. They could have a 15 to 20% drawdown each. And if you looked at each manager on their own, you'd be like, that's good, but meh, I've been getting 12.5% in the S&P. Why bother, right? But this amazing thing happens when you put 50 together. You still make 10%, but your Sharp goes to 2 or 2.5. Nothing changed except you just put them together. That is diversification. That is true diversification, not just taking 500 stocks in the S&P and then that is diversification of total income stream, total risk. That's the alchemy of risk. That is what's happening at the hedge fund level. And I think that's the critical point. And to your point, the hedge funds are capturing too much of a large share, right? This is due for democratization. But the key points here that that make it challenging for an ETF, and these are the things that we need to find solutions for, is getting the leverage and getting the capital efficiency that these hedge funds do, because it's all done internal. All the strategies are done internal. It's very different to have a fund of funds relative to a multi-strategy hedge fund, because the multi-strategy hedge fund, at the end of the day, only probably deploys 60% of the capital because they're all in-house and gets embedded leverage, right? So that 10% yielding strategy all of a sudden yields 15, 20%, still at that 2.5 sharp. And that drawdown, which went down to 5, right? Maybe you take it to 7.5, 8, which is fine. It's the leverage that's critical, because a lot of these strategies aren't scalable. And if you can get a capital efficiency of leverage, and that's the key to deploying this, providing that leverage internally at scale for these strategies is important, because you can get a lot of great Sharpe ratios, but getting the returns, the actual total returns, is hard, and getting them scalable. And I think that's a critical point here. And I think that's the real thing I think a lot of us are trying to solve for.
So I have a question for you, Bob, and feel free to jump in here, Jem, as well, because I've been quietly listening, but very intently, to this conversation, because you've kind of moved into my territory and what I've been spending the last 35 years working on, and that is exactly uncorrelated or non-correlated strategies. And as Bob rightly pointed out, or you, Jem, trend following is certainly one, perhaps the one, when you look at that. So one of the things we do at the shop that I work with is we have a chart where we look at the pre-crisis, so 2002 to 2007 period. We look at the actual crisis, 07 to 09, and we look from 09 to now. And when I look at the correlation, for example, take global macro from the official databases, it actually has positive correlation throughout any of the 3 periods, between somewhere 25 to 60 plus % correlated to the S&P from 09 to 2024. Okay, so my question is just sort of more an understanding of it. Because of course I agree with what you say, that's the magic. How do we do that? And of course I have my strong opinions about replication in general, but that's fine. But my question is, within the replication world that you operate in, Bob, how do you get the non-correlation, say for example, from global macro, when the underlying strategies appear to be pretty correlated, or somewhat correlated, let's call it that, to the S&P 500, if we are, as you both seem to agree on, heading into a period where, say, equity returns will be much weaker than perhaps we've gotten used to? How do we bridge that gap?
Well, I'd say the first thing is, if you look at macro over the course of the last 15 in the post-GFC period, I'm not quite sure what data you're looking at, but stuff
I'm
that
using
I look
the
at,
Barclay Hedge database.
Yeah, which if you look at a holistic look at macro in particular, and there's some reasons why the Barclay Hedge index is a little more tilted, a little better for your equity long short managers than it is for your macro coverage. You see correlations that are, in the, 0.3 type range, which is pretty good, because anything moving up into up into the right is going to have modest positive correlation during the stock market boom, which we've seen in the past 15 years. I think you could also see through that time frame some of the defensive benefits of something like macro, where you've got very, very strong performance in 2022 offsetting the performance of both stocks and bonds during that period, because of the flexibility to be able to go long and particularly short during those environments, and where those managers have done particularly well. And so I think, if you look at it over a variety of different time frames, those macro strategies are quite beneficial to a portfolio, both from a correlation standpoint, but also from a risk standpoint, where one of the things I like to talk about a lot when it comes to things like macro strategies is, the asset managers, what they're particularly good at is helping contain downside risk, which, when you think about a return consistency perspective, that's really beneficial. And so you have modest correlation, good protection on the downside and defensive properties. And that's the kind of I like to describe it a little bit like an all-weather alpha, which is like, you want to have something. One of the challenges with trend following is, it's defensive and it's good. It exhibits defensive properties, but it also has long periods of poor performance, which make it, or mediocre performance maybe is the better way to describe it, which make it challenging for a lot of investors to hold in their portfolio. Whereas you've got something like macro, you have the flexibility to move beyond just trends and look at other elements driving the returns. And so you can get some of those defensive properties with the sort of, good returns also during good times that make it a strategy that's a little more reliable in terms of being able to stick with it in investor portfolios.
And when you do your replication, do you replicate an index per se?
Yeah, I mean, what we do functionally is look at all the different indices because each one, we could spend a lot of time down in the weeds about the nuances of all the indices, and probably you and I would enjoy that conversation, but probably the listeners are not that interested in the weeds of hedge fund index construction. But functionally, what we do is we look at all the different sources of different hedge fund performance information, and we basically use all of them as inputs, in part because each index has its own idiosyncrasies, and you don't want to get too reliant either from a performance information perspective or frankly from a business perspective on any one particular index, because it can be any one index can be a little wonky or incomplete in terms of its coverage. So we look at all of them and average them together in various ways.
And Niels, I would add to your correlation comment, beta is not systemic to these hedge fund alpha strategies. I think the reason that you see the positive alpha is quite simply because everybody's been kind of cheating, right? Like in the sense that like hedge funds have to compete with stocks and bonds. And when stocks and bonds for 40 years have been in a 12.5% annualized rate, they're providing non-correlation at their core, and they don't need to have beta, but they prefer to have some beta in order to at least compete. And so my view is whether it's macro, global macro, or equities, all the models, everything's subject to recency bias. And so everything is kind of pushed to be a bit more correlated. And I think if you start to see that that's not as important, right? I think those betas can easily be brought down and will. Not to mention, I think the alpha and edge becomes more non-correlated in a world where you have more disjointed, particularly with global macro, where you have more kind of things happening cross globally. Things become less correlated cross country, which means there's more non-correlated alpha. And I think that's an important point.
No, I agree with that. And of course, you're right. I mean, all of us have had to compete with some very strong equity markets and so on and so forth. And there should be hopefully more of a difference, so to speak, in a world that becomes more challenging for sure. Since we're coming up to the hour point or so, I want to give you, of course, Bob, a chance to take us in a direction that we didn't take you, or Jem, if you want to, if there's anything else you want to bring up. My list of questions is much longer than what we've touched, from Japan to, debt. And by the way, we're recording today on the 2nd of June. And, over here in Europe, especially for those of us who were in the markets when we had the financial crisis and the bond crisis some years ago, every time politicians were out saying something like, "Oh, we're never going to devalue, or we're never going to break the old European monetary system that existed and broke in 1992." Every time they said that, you kind of felt they're saying that because it's probably not going to hold. So I couldn't help notice that Besant today came out saying, "Oh, the U.S. is never going to default." Just thought that was kind of an interesting comment out of a sudden. Anything you want to leave us with, Bob?
Well, I think the only thing sort of going back to the macro, the more sort of strategic macro perspective that we didn't really touch on too much is we've talked a lot about economic decoupling, but the thing that we haven't really talked about is financial decoupling. And I think that's a really important sort of underlying theme that is really, that this is just getting started. This, for the last 20 years, basically, the U.S. has absorbed the vast majority of capital, global financial investment. And part of the reason why that was because the U.S. 25 years ago was really driven by reserve accumulation, although that hasn't really been a story in the post-GFC period. It really has been about how, essentially the U.S. was the most attractive place for capital. And as we create barriers, as we do strategic decoupling globally, I think there's a lot of portfolio managers that are looking at the situation and saying, why am I so radically overweight U.S. assets? Like, why, European big institutional allocators have have funded something like 30% of the incremental demand of U.S. stocks over the course of the last 10 or 15 years. That is a lot. That is a huge flow coming from those allocators, and prices are reflecting that, meaning weak prices elsewhere in the world and very high prices in the United States, or weak currencies in the rest of the world and a dollar which has sold off, but like in any strategic sense is not that far off from secular highs. And so I think this is the sort of thing we've talked about becoming enamored with 60-40. You've also become enamored with U.S. stocks outperforming everything else in the rest of the world. And these sorts of things take a long time to change. Like if you've sat in a European pension fund, investment committee, that it is slow moving, let's say. But once the ball gets rolling, it can go on for a long period of time. And so, we could easily have a circumstance where that unwinding is detrimental to the dollar, beneficial for foreign stocks for the first time in 15 or 20 years, and really a totally different secular dynamic than what we've seen in the post-GFC period. And it's something that I think, people kind of were like, oh, look at those German defense stocks going up a lot. And then we're like, that was a flash in the pan, forget that. And underlying it, who knows, tactically might wiggle up or wiggle down, but like we are more likely than not moving into a world where foreign stocks, particularly from a foreign equity investor's perspective, are going to look a lot better, meaning their own domestic markets are going to look a lot better from their own currency perspective than U.S. assets for an extended period of time. And so that's an underlying trend that I think is an important one tactically and strategically to be thinking about as well.
Yeah, and I think particularly, one thing that people aren't talking about too, just is this, the new budget, right, has significant amount of, remittance taxes on foreign investment. If you're trying to encourage domestic investment, right, that's probably not the way to do that. Foreign investment, that's not the way to do that, right? And I think there are also, things in there that where we can pull levers in the U.S. to punish, right, certain entities. And so if you're going to start manipulating and changing kind of the rules of engagement with international investment and close your borders in some ways, that can cause some major shifts in psychology among international investors.
I just got a warning saying that Bob's microphone has been disconnected, so he simply cannot give us any more of the wisdom. But I think it's a good time to wrap up. And actually, both of your points right here, I think, are very good in terms of why, as you both agree, things like global macro or diversifying, trend following, whatever it may be, but things that has a big playing field, a big sandbox, could be really, really important in the future for sure. So, as Bob, you cannot say anything, I want to thank you from both of us for another tremendous conversation. We got around a lot of subjects. We could have continued on many more. We stayed away from those we've had agreed on initially not to go to. So I think we did pretty well. Look forward to having you back in the future because, of course, it's a very global macro-driven world we're in. So from Jim and me, thanks ever so much for listening. We look forward to being back with you next week as we continue our Global Macro series. And in the meantime, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.